Good morning and welcome to the Killik & Co market update. We've had some uncertainty in global equity markets this week following some signs of weakness in the US labour markets. On the one hand, this is bad news because it suggests that the global economy is slowing down, but on the other hand, it could be good news because it might mean that the Federal Reserve will slow down on raising interest rates. Here's US quarterly GDP growth since the start of 2020. You can see those big drops during COVID, followed by a big rebound when lockdown eased. Since then, the trend in GDP growth has been generally downwards. Growth was negative in the first 2 quarters of 2022, and 2 consecutive quarters of falling GDP is the definition of recession. However, at the time, many were saying that it didn't feel like a normal recession because the labour market was so strong. Unemployment was very low, and companies were still actively hiring and creating new jobs. Here's the unemployment rate over 20 years. The rate is still very low, but the last set of data did show an increase from 3.4% to 3.6%. We've then got job openings, i.e. the number of vacancies being advertised. The number for February was lower than expected at 9.9 million, dropping below 10 million for the first time since May 2021. The health of the US labour market is a crucial factor in the determinant of where US interest rates are going, so we'll be keeping a very close eye on this labour market activity. This week, we've also had Jamie Dimon's latest shareholder letter. He's been the chief executive of JP Morgan since 2006 and is very highly regarded. JP Morgan is arguably one of the best banks in the world. While many banks lost huge amounts of value in the financial crisis and their share prices have never recovered, JP Morgan shares are currently much higher than they were pre-2008. Jamie Dimon's shareholder letter is always well worth a read. The latest one was quite critical of how banks are regulated and the design of the annual stress test that banks are required to undergo, but it did contain some reassuring comments about the recent issues with Silicon Valley Bank and with Credit Suisse. Jamie Dimon said that recent events are nothing like what occurred during the 2008 global financial crisis, which barely affected regional banks like Silicon Valley Bank. In 2008, the trigger was a growing recognition that $1 trillion of consumer mortgages were about to go bad, and they were owned by various types of entities around the world. At the time, there was enormous leverage virtually everywhere in the financial system. Major investment banks, Fannie Mae and Freddie Mac, nearly all savings and loan institutions, off-balance sheet vehicles, AIG and banks around the world, all of them failed. The current banking crisis involves far fewer financial players and fewer issues that need to be resolved. And finally this week, oil cartel OPEC Plus has announced a surprise cut to oil production. Oil prices surged following Russia's invasion of Ukraine, but Brent crude has steadily declined in recent months due to fears of a potential recession hitting oil demand. The price dropped from over $120 last summer to below $80 last month, and OPEC was clearly unhappy about the lower price. After the OPEC Plus announcement, Brent crude jumped above $80 again. A higher oil price could feed into higher levels of inflation, so central banks will be watching this very closely and using it to help them decide where they go with future interest rates. Moving on to have a look at next week, we're expecting results out from LVMH, JP Morgan and United Health Group. That's it from us, so have a great Easter weekend and we'll see you next Friday.